As we approach the opening bell on this Friday, November 14th, 2025, Bitfarms Ltd., trading under the ticker BITF, is already signaling a day of intense pressure. After a brutal session yesterday that saw the stock plummet, it closed at $2.60. But the pain is not over. In the current pre-market, the stock is indicated down at $2.41, representing a further drop of 7.34%. This isn't just a minor fluctuation. This is a continuation of a severe market repricing. If you are watching this collapse and assuming it's just the stock dutifully following the spot price of Bitcoin, you are missing the real fundamental story. This steep decline is not about the day-to-day movement of cryptocurrency. It is a direct and painful reaction to the company's third quarter 2025 earnings report, which was released yesterday, and it has completely undermined the core belief investors had in this company. The long-held expectation for Bitfarms was that it was a simple, leveraged play on Bitcoin. Investors bought it because it was a pure-play miner. The narrative was attractive. Bitfarms was building a large-scale, vertically integrated mining operation, often highlighting its use of low-cost, green hydropower, particularly in its Canadian and Paraguayan facilities. The thesis was straightforward. If you believe Bitcoin's price will rise, you buy a miner like Bitfarms to get an amplified return. That was the expectation. The reality, which was delivered in a brutal fashion yesterday, is that this thesis is now broken. The company just announced a staggering third-quarter miss. Revenue, earnings, and mining efficiency all failed to meet forecasts. But the bigger story, the one causing this panic, is that the company simultaneously announced a massive strategic pivot away from its core identity. Bitfarms is no longer just a Bitcoin miner. It is attempting a costly and complex transformation into AI and high-performance computing, or HPC, data center provider. The company you thought you invested in is changing its entire business model right before your eyes, and it's doing so from a position of financial weakness. Let's first look at the damage from the earnings report, because the numbers are stark. For the third quarter, Bitfarms reported a net loss of $46 million. This equates to a loss of 8 cents per share. The market was not prepared for this. The consensus estimate was for a loss of just 2 cents per share. That is not a small miss. That is a 300% negative surprise. The bleeding continued on the top line. Revenue for the quarter came in at $69.25 million. While this was up 156% year over year, it dramatically missed the consensus forecast of $88.72 million. A 22% revenue miss is a massive shortfall that signals a deep issue in operations or planning. The operational metrics tell the same story. The company earned 520 Bitcoin in the quarter, but the average direct cost to mine a single coin was $48,200. With Bitcoin's price being volatile, that high cost of production leaves very thin and sometimes negative margins. This is the financial backdrop: a massive earnings miss, a significant revenue miss, and a high cost of production, against which the company is now asking investors to trust them on a complete strategic overhaul. This pivot is the real story. In the earnings release and subsequent call, Bitfarms management was clear. They are winding down their focus on Bitcoin mining. The company announced plans to convert its Washington State facility, an 18-megawatt site, to support AI and HPC workloads. The CEO, Ben Gagnon, tried to frame this positively, stating, "Infrastructure is not a bubble, and we do not want to cap our upside by signing leases prematurely." He is effectively arguing that the real value is not in mining, but in owning the energy infrastructure and data centers that the AI boom desperately needs. He highlighted a 2.1 gigawatt power portfolio and a $128 million agreement to equip the new HPC-ready sites. The market's reaction, with the stock collapsing 18% yesterday on staggering volume of 112 million shares, tells you what investors think. This pivot is seen as incredibly risky. It requires an immense debt load. The company just closed a $588 million convertible notes offering to fund a build-out in a space where they have no proven track record. They are now competing with established, specialized data center REITs and tech giants, not just other Bitcoin miners. Analysts are spooked. H.C. Wainwright, for example, maintained a buy rating but slashed its price target from $5.50 all the way down to $4, citing this AI rotation and the market's clear disappointment that no major AI contracts were announced alongside this new strategy. Zacks Investment Research was even more blunt, placing a sell rating on the stock, warning that while the pivot is appealing, it faces significant hurdles like regulatory approval, the challenge of securing long-term contracts, and the immense debt load. This brings us to the short-selling activity, which is a critical piece of this puzzle. Given this new high-risk thesis, you would expect short sellers to be interested, and they are. According to the most recent data from Fintel and Nasdaq, Bitfarms has a very significant short interest. Approximately 88.18 million shares are currently held short. This represents 16.79%, or nearly 17% of the company's entire public float. This is not a small number. It signifies a major contingent of institutional and sophisticated investors who are betting heavily that the stock price will continue to fall. But here's the actionable insight you need to understand. Many retail investors see a high short interest number and immediately think about a short squeeze. This is highly unlikely here. You must look deeper. The days to cover ratio for Bitfarms is currently just 1.29 days. This means that given the stock's high trading volume, all 88 million shorted shares could be bought back and covered in just over one trading session. A squeeze happens when shorts are trapped in a low-volume stock. That is the opposite of what is happening here. Furthermore, the short borrow fee rate, the interest rate shorts have to pay to borrow the shares, is a very low 0.82%. This tells us it's cheap and easy to short BITF. There is no panic among the short sellers. They are not being squeezed. They are comfortably riding this stock down, and their bet is not a technical one, it is a fundamental one. They are betting that this AI pivot will fail, that the debt is too large, and that the earnings miss is the sign of a poorly run company. If you're an investor, you need to know how to track this. You can find the official short interest data published twice a month on the Nasdaq website itself. You can also use financial data services to watch the borrow fee rate. If you suddenly see that rate spike from 0.82% to 50% or 100%, that would signal that shares are becoming scarce and the shorts are getting nervous. Right now, they are calm, and that should tell you everything. What's your take on the 16.8% short interest? Is this a fundamental bet against the AI pivot or just market noise? This is a far cry from the discussions that used to surround this stock on platforms like Reddit and X, formerly Twitter. For years, the retail sentiment was bullish. Investors would compare Bitfarms to competitors like Marathon, MARA, and Riot Platforms, RIOT, arguing that BITF was undervalued. They championed the company's green hydropower narrative and its low cost of production. Those discussions are now being drowned out by the harsh reality of the Q3 numbers. The sentiment has shifted from excitement over a Bitcoin proxy to deep anxiety about a company that just missed earnings by 300% and is now embarking on a billion-plus gamble. So, where does Bitfarms go from here? The future outlook is balanced on a knife's edge, and it all comes down to this pivot. The bear case, which the shorts are betting on, is simple. Bitfarms is a company in distress. It is failing at its core business of mining Bitcoin profitably, as evidenced by the $48,200 cost per coin. It is now taking on hundreds of millions of debt to enter a new, highly competitive field, HPC data centers, against established giants, all while its core business loses money. In this scenario, the company burns through its cash, the debt load becomes unserviceable, and the AI contracts never materialize at the scale needed to justify the expense. The stock will continue to slide as dilution from the convertible notes looms and confidence erodes completely. The bull case, however, is a long-shot path to redemption. The bull case rests entirely on the CEO's statement that infrastructure is the bottleneck. If Bitfarms can successfully and quickly convert its power infrastructure into fully operational, liquid-cooled data centers, and if it can sign long-term leases with the blue-chip AI companies that H.C. Wainwright mentioned, then the company's valuation could be re-rated. It would stop trading like a volatile Bitcoin miner and start trading like a high-demand, high-margin AI infrastructure company.
The $4 price target from Wainwright, which is still significantly above today's $2.41 pre-market, is based on this hope, the hope that a deal could be announced much sooner than the 2027 timeline. This is the central conflict. The expectation was that you were buying a simple, profitable Bitcoin miner. The reality is that you own a high-debt, high-risk infrastructure construction project that just posted a $46 million net loss and is being aggressively shorted by institutions. The old thesis is dead, and the new one is a gamble. Comment below with your thoughts. Is this AI pivot a smart move to escape Bitcoin's volatility, or is it a last-ditch effort that will end in failure?